Hello friends, welcome again. This is SK Advisory Private Limited. This is episode 2 continuation of volume and trading. Sudden volume spike is the one that happens abruptly and it's usually the result from major unexpected news or major releases that are expected like economic indicator releases or balance sheets. When we talk about events that are scheduled, the volume spike appears abruptly in the chart but it is expected. When we talk about unexpected news, the volume spike is sudden and unexpected. As we can see in the charts, this volume pattern produces a sudden spike. The sudden spike will confirm the price movement at the corresponding period. Notice how the volume increases sharply above the average volume highlighted by the black line in the volume histogram. There is also the crescendo spike, which as the name suggests is a spike that is preceded by a crescendo or gradual rise in volume. This happens as a result of buyers and sellers increasing activity in the market for whatever reason, which might not necessarily have to do with news events or economic releases. In this chart, we can see a crescendo spike, meaning a slow rising volume that eventually peaks and then drops. In summary, the sudden spike represents an abrupt increase in market activity while the crescendo spike represents gradual increase in the market activity. Volume drop is a less dramatic event, but it also contains important information about the market. Volume drop is represented by decrease in volume or decrease in trade activity. The drop in volume means that the supply and demand are near an equilibrium state, so oftentimes you will see price moving sideways as volume drops. In this chart, you can see how price accelerates within the blue rectangle with volume gradually drops. Notice also how I am giving examples of different markets to show slightly different measures of volume related to the same thing. The example showed a sudden spike in currencies, crescendo spike is stock and a volume drop is future. Volume spike and volume drops are the two most basic patterns that emerge in volume histograms. Given these two basic patterns, we can move on to the standard interpretation of volume in relation to price action. The standard interpretation is made by comparing patterns in the volume histogram to price action. We have four basic interpretations when volume is rising and price action is also rising. We have the confirmation of a bullish movement. In other words, the bullish movement has enough volume to be sustained. When volume is rising and price action is falling, we have the confirmation of a bearish movement. In other words, there is enough volume to sustain the bearish movement. The volume is falling and price action is rising, we have a weak bullish market, meaning that volume is not sustaining the current market movements upward. When volume is falling and price action is falling, we have a weak bearish market, meaning that volume is not sustaining the current market movement downwards. That's it for this session. Stay tuned because the next topic is very interesting and very useful. If this information is helping you, then do like, share and subscribe to our channel and press the bell icon to be notified on every update from SK Advisories. Thank you.